But with this, let's go ahead and start into the next part of our discussion, and that is answering the question, how do firms value assets? And I'll dovetail into this and tell you that a firm is simply a large or small perhaps, but very complex asset. A printing press might be a smaller yet less complex asset. So how do firms value assets? Simple assets or complex assets? Well, we value them based upon the accounting information and the financing information that spills from them. And we put that together. And there's three relatively well-accepted valuation metrics or methods, if you will. One of those I think of as being simply the firm's book value. Another is its production value, and another is its market value. So we're going to look at those here in a few minutes. We'll look at the firm's capital structure. We'll look at some fundamental principles. We'll look at something called enterprise value, and we'll start to look at cash flows. So let's start with, let's start with, I've already gone through all this, excuse me. We're going to start with how firms value assets, and we'll look here, and I'll ask the question, what is it that a firm produces for its stakeholders or its owners? So Diana, let's assume that you've got a company, and David is thinking about being an investor in your company. David, what does Diana's company produce that you want to invest in? And let's say that this happens to be a ski and snowboard company. What does her company produce that causes you to want to invest in it?
Increased value is what should be producing for me to want to invest.
Okay, so that's going to, and I'll tell you, that will be the outcome. Well, hopefully that will be the outcome. It might be a decreased value, okay, but hopefully not, hopefully an increased value. But some value structure is what it's going to produce. But that, I'm going to tell you, is actually the outcome of what it produces. So Michael, Allen, I'll let you come off of mute. That shoe manufacturer that you've just been jonesing to own, okay, what does it produce for you versus what does it produce for customers?
So for customers, it's production value, right? Because it's actually creating a good.
Well, for customers, it produces shoes, right?
Mm-hmm.
Okay. What does it produce for you, though, as an owner or an investor in the company?
Would that be like book value?
No, don't look at my little things because the answer's not there. But good for you for trying, Michael. I'm proud of you. It produces cash flow, right? So I come to Matt, my investment advisor, and if I am just a cold-hearted, dyed-in-the-wool, steel-oriented investor, which for the most part I happen to be, as long as it's ethical, plausible, legal, and moral, then I don't have a problem investing in it as long as I can see that it gives enough cash flow to warrant what I had to pay to get it. Okay? Oh, true. Like some investors, I want to invest in something that I don't understand. Okay? But otherwise, I'm pretty just cold-hearted about this because it's all about numbers and cash flow. I mean, I believe that Gordon Gekko was a prophet just before his time when he said greed is good. And you guys, some of you know the name Gordon Gekko and realize it's a fictitious character from the movie Wall Street, and others of you didn't know that, but he famously said greed is good, and the fact of the matter is greed, as he was talking about it, is good. It's productive. It gives something to the capitalist system that creates jobs and resources and innovations. It's not greed in the Simon LeGreed kind of let's manipulate the world greed.
Hey, Rick.
Yeah.
Just a question about cash flows. So, because when I did some of my undergrad was accounting, and we talk about a cash flow statement versus a regular statement, they make a point that they're very different things. And so I just want to understand, like in my mind, when you asked that question, I was thinking, well, the value to me would be a revenue stream or an income stream. And you use the word cash flow specifically. So I just want to make sure, because I've looked at some of the materials already for the class, it seems like cash flow is going to be a concept that we talk about a fair amount. I just want to make sure I understand it in the right terms. Like, how would that be different than just a revenue stream or an income stream, and how is that difference important?
It's a good question, Matt. In fact, before we're done this evening, we're going to go through what I refer to as notions of cash flow, which you could say inputs to the cash flow equation. And they all are versions of cash flow. But we're going to end up on a critical version of cash flow that is referred to as free cash flow, or FCF. It is the preeminent cash flow, and that's where we will spend most of our time. All the other elements or notions or inputs to cash flow conspire to end up in free cash flow, okay? And yes, it is very different than net income. It's different than operating income, and it certainly isn't simply revenue, because revenue hasn't had any expense exposure yet, right? But we're going to go through all the accounting to get to something that financiers praise and business owners and stakeholders rely on. Well, what does a firm produce? For us, it produces cash flow. I don't care if it also happens to make skis or automobiles or sells airline tickets or perfume. I couldn't care less.
Rick, I can't hear you.
Can anyone else not hear me?
I can hear you.
Hear you now.
I hear you.
Okay, you may just have frozen up there for a moment, Diana. I apologize. I'm saying that everything that we're going to deal with will end up on this free cash flow structure. Okay. Well, we have a production value, which would suggest that we can create a value for the company based upon its cash flows. We have a book value. What's the book value of a company? Well, we see that value on the balance sheet, don't we? The book value is very easily recognizable. I'm going to open up one of my spreadsheets here real quick. Very easily recognizable. The book value is that which has gone into the creation of the assets and liabilities on our statement here. And again, you guys have a copy of this, and we'll be reverting back to this over and over. We're going to stay with this company, Mira Dravana Enterprises, all block, as it relates to these assignments and for my examples, okay? You'll use different companies within the homework assignments and within the problem sets, but Mira Dravana will be a constant for us as we go through our classes together. Well, what's the value of the assets? It's 175.873, and this one happens to be in millions, okay? And this is for 2019. What's the value of the liabilities and the owner's equity? Well, it's 175.873 because this is a balance sheet, and the assets should equal liabilities plus owner's equity, and in fact they do, okay? The book value of these assets are what we paid for them minus the depreciation that we apply against them. So this 72.59 is the book value of all of our hard, tangible assets for Mira Dravana after they've been depreciated. Well, this is an accounting artifact. It's interesting. It helps us communicate some things. It helps us stay in compliance with GAAP, or generally accepted accounting principles, which have been established by FASB, the Financial Accounting and Standards Board. But from my perspective as a financier, as an investor, this is yesterday's news. This is antiquity, even if it was literally just yesterday, because market values are here and now. They are today. Well, that leads us to the third way that a firm thinks about its assets and how it values assets. Does it through its market value. So a production value is going to have to do with the income or cash flow that it creates. Book value is going to have to do with what was paid for something minus depreciation. But market value is going to have to do with what someone is willing to pay us for this. So if I have a computer and Xinjiang wants to buy a computer, we might reach an agreement. He might buy my computer. Maybe I wanted to sell it for $1,500. He only wanted to pay $1,000. He's a shrewd negotiator, by the way, and so he got me all the way down to $1,100. But if we get to that number, that is its market value. I have a son-in-law named Brandon, and Brandon is the quintessential commercial real estate guy. He's done very well for himself. But Brandon often comes to me with opportunities and says, Rick, here is this property. It's worth $5 million. We can buy it for $1.5 million and some change. And bless his heart, I love Brandon, but my response to him is the same response each and every time. Brandon, if it was worth $5 million, they wouldn't be selling it for $1.5 million and change. Okay? The market value is an easily identified number. It is that which was paid very recently for that asset or one very, very similar to it. Okay? Does that make sense? Okay, let's move on then. So we're going to have to think about morphing from this book value construct on these financial statements, balance sheet, income statement, etc., to how we think about market values. And we'll spend a lot of time doing this. We're going to use some of the equational relationships of time value of money, bond value equations and such. We're going to be thinking about some discount rates. We're going to think about growth rates. We're going to think about return on capital rates, all of these to help us identify how we move from a book value to a market value. And that's not a simple one-step deal. We're going to spend some time on that over the next couple of weeks. As you begin that first problem set, the one that I said is broken into two parts, the first part is all about book values, okay? And if you're given them, maybe some market values. The next part is all about market values, and which is part of why we have it span a couple of weeks. Well, let's think about the firm's capital structure, because this is where book and market values might come into play. So think for a moment. I can look at the firm's financial statements. I can look at its balance sheet, and I can see the book value of its debt, right? Here I have the book value of its mortgages at 4.32, and the book value of its bonds at 30.5. So the book value of its total debt components of 34.82. That's just those two numbers added up. Notice that we differentiate long-term debt from current liabilities. And this is important here. Long-term debt not only is a debt or a liability that's going to exist for a year or more, but long-term debt is part of the company's capital structure. So Jason decided to invest in Miradravana Enterprises, and he did so by loaning the company money. It wasn't so that they could buy some of his products more easily. It wasn't so that he could, it wasn't because he provided labor and they're going to pay him in a few weeks with wages. That wages payable or accounts payable might be some of the current liabilities. It's because he literally specifically invested in the company's capital structure. That's found under the long-term debt, and it's found under the common stock and preferred stock. But these are simply the numbers that were loaned to the company that are still outstanding, so the company still owes, and the money that was given the company when somebody bought, maybe it was Jason or Michael or Mario, when they bought common stock from the company. Now, if Carol buys some of, let's say, Taylor's stock in the marketplace afterwards, let's say Taylor's an original owner of common stock in Miradravana. He bought some stock from the company at its original issue. Now Carol has decided to buy some of that from him, either in a private transaction or a market exchange on maybe the NYSE or the NASDAQ. Well, that money that Carol gives to Taylor, the company never sees that, right? The company only saw the money Taylor gave the company. So that market transaction, that secondary transaction, is not reflected here. It's altogether possible that Taylor bought stock in this company along with everybody else that bought it on original issue when he was 18 years old. Taylor, that was what, a decade or more ago, right?
Yeah, 13 years now.
13 years ago. Well, who cares what the value was 13 years ago? I want to know what the value was 13 nanoseconds ago, because it's all about market and here and now. So we're going to spend a lot of time going from market values, or rather book values, which we largely see here, to market values. Now, in this case, I've actually given you some additional market information. We get to see that at the end of 2019, we see the number of shares outstanding for this company. We see the dollars per share. We see the market value of the common stock. We see the market value of the preferred stock. And some of this information we have over here on the left-hand side will help us determine the market value of the firm's debt. You might not think about this, but the market value of a debt obligation isn't necessarily the outstanding principal balance. It's its market value, which, and I don't want to go into too much detail about this right now, but it changes as interest rates change. It is as living and breathing as the market value of the stock. In fact, I would argue that there's a lot more transaction in this country and in our market economy that are debt transactions, a lot more volume of trading in debt instruments, everything from corporate bonds to municipal securities to treasury instruments, and all the various market of derivatives that have sprung up around those. There's much more of that kind of transaction work in our economy than there is stock transaction.
Hey, Rick.
Yes.
So that, correct me if I'm wrong here, because I just want to make sure I'm thinking about this the correct way. So if I understand what you're saying about the components of capital structure, there are basically common stock, preferred stock, and debt to finance, right? So in that spreadsheet you're showing, an additional information, is it as simple as saying at least how that looks right now, additional information, financial information, is that block represent it just itself the capital structure, or would we have to include some of those other long-term debt items that are on the asset or on the balance sheet?
It's a very good question, Matt. And unfortunately, the answer I have to give you is it depends. If we're looking at this from a book value construction, all the book values are right here. You got them, okay? If you're looking at it from a market value construction, then, well, I've given you some market values here that are related to the instruments here. But these numbers and these numbers are not related. I mean, this may have been, there was 5.57 million raised in common stock 13 years ago. That now is worth 128.11 million.
Okay.
There's not a good straight line. In fact, it's a very circuitous line. We call it a market line, right? So they represent the same things from different perspectives.
Right. So the aging of that balance sheet, I think it goes back to the point you made earlier, which is, because the balance sheet doesn't, the way that the report is, or that a balance sheet originates the information, it changes over time.
Yes.
So like you said, that common stock could have remained at that exact number for the last 18 years. It could have gone way up, way down, whatever the case is, depending on what they issue, or any of those metrics. Whereas the additional information is, based on the current marketplace.
That's exactly right. And you're going to find that there is a quantitative relationship between this 5.57 and this 128.11. It is just not a reliable relationship that we can easily identify, but it is filled with these forecasts and discount rates and expectations and everything. And we're going to wade through all of this in nausea-inducing minutia over the coming weeks.
And one other just quick follow-up question to that, and if this is something that we're going to learn about in the future, that's okay. We can just sidebar it. But so I guess my question though is the inputs that make up, say, how you calculated shares outstanding or how you calculated PE multiple or EPS. Are those coming from the balance sheet and income statement? Or are those coming from somewhere else that isn't static like those?
That's a great question. So I'm going to simplify this, of course, because we don't have 2 years to go through this. We've got 7 weeks, right? I will tell you that for how we will look at this, the inputs will either come from balance sheet, income statement information, or I will give you some given numbers, like I have right down here, or I might give you a story. And in that story, I might give you some other pieces of information that will have to interact with this. You'll get used to what is coming from balance sheet or an income statement versus what's more interactive or what has to have been given otherwise, okay? And then you'll finally get to a point where maybe something isn't given to you, but you should have developed enough understanding and intuition by then to know what it plausibly could or should be. And then you are going to make an assumption and apply those assumptions. And as long as you made an assumption and stated it, and as long as it was plausible, you're good to go. We'll get there, I promise. Okay, so when we look at the firm's capital structure, E stands for common stock, P stands for preferred stock, and D stands for debt. long-term capital debt, not current liabilities. Well, we can value this by looking at the paid-in capital for the common, the paid-in capital for the preferred, and the outstanding balances of the debt, and it'll give us something called V. I don't want you to think of it as value, just call it V. It'll be easier for you, okay? We're going to look at something called fundamental principles here in just a moment, but before we get to them, I want to now go from this first construction of the capital structure down to enterprise value. And enterprise value will be reflected on this corporate finance quick sheet, but I want to talk it through since it's so similar to V. You'll notice it's similar enough that I've said, and it's not V, okay? It is the same E, it is the same P, it is the same D. So the value of the common stock plus the value of the preferred stock plus the value of the debt, which are reflected up here in V, are the same values down here, but in this case, we then subtract C, or cash. We subtract cash. And when we have subtracted cash from these three components, we end up with something called enterprise value. As it turns out, there are a number of ways of estimating enterprise value. We can calculate it clean and simply, like we have here, if we know the inputs, or we can estimate it. And when we estimate it, we do that by some of these valuation model estimations. So the outcome of the valuation models I will introduce you to in the coming weeks. The outcome is an estimated value, and that estimated value is synonymous with the enterprise value. Well, that's going to help you a lot when we get there, okay? I can look at either of these, V or EV. I can look at them from a wholly book construction, in which case I'm just pulling numbers straight off of the balance sheet, right? Or I can look at them from a wholly market construction, in which case I might have used these numbers to get to the market value of those components, common E, preferred P, and capital debt D, okay? And we'll talk all the way through how you do this. It should become fairly second nature to you by the time we're done, and we'll do it over a period of classes. By the way, one of the things that you should know, and this might give you a little bit of comfort at the moment, is that I will start off each class by giving you an opportunity to ask questions about material that you're working on, items that you're working on. I will then move from that to reviewing some of the more important aspects of what we covered the prior week. And then I will move to covering new material. And I will do that exact same thing each time. So some of these metrics that I'm moving through fairly rapidly, we're actually about to hit them again here in just a moment with some actual numbers to them. But you're going to see that I will hit these at least twice in a discussion like this, and probably 3 or 4 more times as we think about applying them. And that doesn't count the time that we spend together in these optional review sessions if you choose to participate in those. Okay? Hopefully that'll give you a little bit of comfort here. I see Lisa here writing for all she's worth, and Lisa, I respect that. I'm the same way. I come from the school of what goes through you sticks to you. Okay? So I'm a big note taker. You should all know that I always will send out to you in advance the PowerPoint for that week, but it's also loaded into Canvas already. It's in fact the entire block where the PowerPoints are in Canvas for you already. So you can also take those. Lisa might even help you to print those out and then make notes on those. You might capture a lot more that way. But it's certainly up to you. But I do the exact same thing. Okay, so I'm going to come back to this corporate finance quick sheet as part of our fundamental principles. And this is something that I sent to you in the WhatsApp. So let me bring it up now. And this is simply a little cheat sheet, if you will, a little relation sheet where I have articulated every one of the items that we're talking about tonight and probably a number of others that we aren't discussing. And I articulate them so that you can see how they come together in the abstract. So I'm not giving you any numbers on this. This is just structure and abstract construction of the algebra or the simple math, if you will. And I'll talk through every one of these that are relevant that you probably aren't familiar with, like no plat. What the heck is no plat? We're going to deal with something called WACC, IGR and SGR and different things that you probably know something about. ROIC, maybe you know it. You might have heard of IC or invested capital, but I'm going to tell you there's two ways to get to it. And I'm going to tell you that there's a whole bunch of ways of thinking about discount rates, and WACC is only one of them. And we're going to play with this stuff a lot. I've given this to you. If I were you, I would keep this printed or digitally at the ready for each of our next several classes together. I'm not going to send it to you each week, but it is available for you. And with that, let me show you where some of these are coming from. I'm going to go to another website, and this site is
question.
Yes.
Where was that quick sheet located again?
So I sent it to you through WhatsApp a few hours ago,
gotcha.
but it's also, and in fact, I'll show you here where it comes from, and I'll show you on Canvas how to get it again as well, Jason. So if you go to richardhaskell.net, is a little website that I have, and each one of these little tabs on the left have all kinds of material, including a whole series of quick sheets. And here, this corporate finance quick sheet's one of them, okay? Normally, I will send you in advance, so an hour or two before our class, maybe even 3 hours, I'll send you digitally the items that we're going to be working off of that night, including the PowerPoint and the worksheets and problem sets, etc. But if you haven't seen them yet and you want them, I have them all housed in this this website, but I also have them linked in each of the modules for you. So here in Module 1, here's the corporate finance quick sheet. Here's the financial statement ratios. So everything, and I mean everything that we're going to deal with is already loaded here in Canvas for you. So if you don't remember where it's at or you just don't have it on you, it's here with that week. You know, the week in which it was introduced. I don't repeat it each week because otherwise it's going to be 20 feet long, right? But I give it to you in the week that it is introduced. Okay? So let me go back to that quick sheet again then. So many of these relationships, like net income, retained earnings, profit margin, are ones that you should know either from your accounting classes or your MBA 603 class. And to the extent you don't remember them readily, then you've got some quick sheets or some little cheat sheets here that you can use for them. And I'll go through some of the more important parts of this tonight as we walk through this. So let's look at some numbers from those capital structure and enterprise value abstractions. So here I'm using Mirage Ravana as an example. And I'm just taking numbers directly off of this balance sheet, income statement, and market information. And I'm now going to apply them to that capital structure of E plus P plus D. And when I do so, I find that, well, E, or in this case, the market value of the common, is right here. I've got the number of shares of common times the price per share gives me the market value of the shares of common at 128.11. Market value of the preferred shares. Well, there's 4.3 million preferred shares out there. They're at $1.15, they're $1.15 each. So together, the market value of them is 4.945, or almost $5 million. So this would be E, this would be P. Now, in this case, we're not going to calculate necessarily the market value of debt because you don't know how to do that yet. We'll use the book value of debt. And in another class, I'll give you a sense of when you should use the book value of some debts and when you should use their market values. For example, let's say that Andrew decides to loan me some money from the Bank of Trexler. And it's a 3-year loan. It's at 10% interest rate. And every quarter I'm making payments, and principal balance goes down and I pay the interest each time, right? So this mortgage, or this, if that bank loan was here, we would see the book value, which is the amount outstanding, right? And as it turns out, a bank loan, its book value and its market value are identical. On a bank loan, just like a mortgage and just like a credit line and like a long-term note payable, the book value and the market value are identical. Well, why is that on a bank loan? Well, because if Mario's the banker and I walk in, or Andrew's the banker, it doesn't matter which one, I walk in and say, well, this loan has 30.5 on its outstanding balance. Here is a check for $12 to pay it off. So I walk into you with this 12, let's even say it's $1 million or $12 million. And I want to pay off something that you're carrying on the books at $30 million. Mario, what's going to be your response?
No.
Yeah. In fact, you're going to be a lot more aggressive about it. You're going to call security. You're going to hit the red panic button. You're going to say no because you had a contract. I've agreed to pay you 30.5 if that's the outstanding balance, because it's not a market instrument. It's a contractual instrument. But if this was a marketable bond trading on the various securities exchanges, then we might be able to come up with a market value for it. So we'll go through this metric or matrix rather at another time so you can know of these long-term debts, which ones do we simply take book values and which ones do we calculate market values. But in this case, since we don't have the market values, we'll take the book value of the debt and the market value of the equity, common equity, and preferred stock, and we're going to call those V. And as it turns out in this case, E plus P plus D equals 167.87, let's call it. Well, that's the capital structure. I now want to think about my enterprise value. But before we do that algebraically or in the abstract, what is enterprise value? What's it mean? What's it stand for? Does anybody know?
It seems like if you're removing cash, right? It's almost like, I don't know the best way to say it. I don't want to say it's just its infrastructure, but cash is like the blood and the rest of it's like the body, basically. That's, I guess, the way I think of it. And if you're going to sell it, right, you're going to sell the business, and evaluate it in a certain way, you have to exclude the cash because you're thinking about what is its value to you in the future, not necessarily just how much cash you have on hand right now, because the cash is going to get spent, right? Cash isn't, unless you invest it, is not going to actually create value down the road.
Yeah, I think you're right, Matt. In fact, you're going to find that the common notion of enterprise value, just as I told you a few minutes ago, is A, we can calculate it like I have it in the equation right here, and E and P and D are the exact same inputs as they are for the other equation. So we can calculate it through the equation, or as I told you a few minutes ago, we can estimate it through one of these valuation estimators that we'll use. Well, that's going to help us a bunch, as it turns out. But what's enterprise value really? Well, if it's the estimated value, it's the value of the company or whatever that asset happens to be, right? Well, how do I think of its capital components and its value? And Matt, you've hit on exactly this cash contribution is important to us. Let's assume that I'm buying Schmidt Enterprises and you are charging me $30 million for Schmidt Enterprises, and Schmidt Enterprises has $5 million of excess cash on the balance sheet. So I give you a check for $30 million. I immediately own that $5 million of excess cash. How much did I really pay of my own money for the business, Matt?
25?
25. I paid enterprise value. Okay, so whenever you see enterprise value, this subtraction for cash always says minus cash. Practically, it's minus excess cash. Now, we're going to treat it as minus cash because you don't have the ability to know yet if a balance sheet shows $10.9 million, how much of that is excess and how much of that is necessary.
When you say cash, do you include any very liquid assets in that, or is it simply green cash sitting in a savings account?
Great question, Mandy, and thank you for asking it. You'll notice here as I'm looking at this that I usually show this as cash and securities. So it's cash and very liquid equivalents. Now, accounts receivable, We're not in control of when those pay us, are we? Inventory, we're not completely in control of when we sell it. But our cash, our securities, our savings, our money market funds, those they're either cash right now or they can be very, very quickly. So it is cash and securities. Good for you. Thank you. Well, when I have subtracted cash out, it's a lesser value. It's 156.93, which is less than the value of my capital components because of this adjustment for cash, which means the value of the company is less than the value of its capital components. The estimated value of the company is less than the estimated value of its capital components. And that might seem a little counterintuitive to you at the moment. I'm simply going to ask you to believe me. And we'll get to a point where you will have effectively proven it to yourself. So here we have the value of the capital structure being slightly greater than the enterprise value. And again, that's a function of this deduction for cash, which means that the value of the capital components may not necessarily be the value of the company if the enterprise value is our estimated value. Now, the key to these being the same or not resides in this issue of cash. So I've said that we're going to treat this as though it is exactly what all the finance textbooks tell us to do, and that's take E plus P plus D and subtract cash or cash equivalents from it to come up with enterprise value. But I will tell you in practical terms that you wouldn't subtract all the cash, because the moment you take all the cash out of the company can no longer operate. Cash is the lubrication in the company's cogs. You take cash out of it and it seizes up. So it's really excess cash, but for the purpose of these discussions, problem sets, etc., we're just going to treat it as though cash is a unique amount and is whatever is showing on the balance sheet. Fair enough? Okay, so let's move on.